Stablecoins, blockchain, and the next era of money, a strategic briefing. 1. Genius Act, the legal green light for stablecoin infrastructure. The passage of the Genius Act marks a legislative watershed. For the first time, the U.S. federal government has codified legal clarity around stablecoins, opening the door for institutional adoption, private sector innovation, and mass market integration. Stablecoins, digital representations of fiat currency on blockchain, can now be issued and transacted with federal regulatory backing. This effectively legitimizes blockchain rails for global financial transactions and unlocks widespread business use cases across payments, remittances, treasury management, and more. Footnote: the Genius Act enables legal issuance and use of stablecoins, establishing a regulated on-ramp for blockchain-based finance. 2. Why stablecoins matter: frictionless, borderless, programmable money. Stablecoins merge the best of two systems, the price stability of fiat with the operational efficiency of blockchain. Fast, settle payments in seconds, not days. Cheap, transaction fees under 1 cent in many cases. Global, no bank, no borders, no delays. Programmable, money that follows rules automatically, e.g., smart contracts, conditional transfers. These features make them indispensable for use cases like global payroll and freelance payments, cross-border commerce, protecting wealth in hyperinflationary economies, on-chain lending, saving, and finance without banks. Footnote: stablecoins are designed to be usable money, fast, borderless, and programmable while maintaining price stability. 3. Stablecoins versus banks, a structural unbundling. Traditional banks bundle services, deposits, payments, foreign exchange, lending, and gate them behind compliance requirements. Stablecoins and blockchain unbundle these services and democratize access. Store money in a self-custodied digital wallet. Send money instantly, domestically or abroad. Get synthetic access to dollars or other currencies without needing a bank. Borrow based on smart contracts and on-chain collateral, not credit scores or gatekeeping. This disintermediation threatens legacy institutions that profit from control, fees, and exclusivity. Footnote: stablecoins and blockchain unbundle banking functions, reducing dependency on traditional institutions. 4. Global access, serving the underbanked and unbanked. In the U.S., 1 in 6 households is unbanked or underbanked. Globally, over 1 billion people lack access to traditional financial infrastructure. Stablecoins offer them access to U.S. dollars without an American bank, the ability to save and transact without government permission, protection from local currency collapses, e.g., Argentina, Lebanon, Nigeria. This is not theoretical. Stablecoin adoption is already exploding in unstable economies, where demand for reliable stores of value is highest. Footnote: stablecoins offer sovereign-free access to stable currency, giving underserved populations a financial lifeline. 5. From margins to mainstream, institutional and corporate adoption. With regulatory clarity, major corporations and financial institutions are moving in. Visa and MasterCard are integrating stablecoin payments into their networks. Coinbase, now at the White House, is positioning itself as a core infrastructure provider. Ripple has launched Rust and partnered with BNY Mellon, the largest asset custodian in the world. Circle, USDC, has gone public with $64 billion in circulation. Tether, USDT, leads globally with over $150 billion in issuance. We are entering a phase where stablecoins are not alternative finance, they are finance. Footnote: leading financial institutions are actively integrating stablecoins into global payment and custody infrastructure. 6. Competitive edge, America's strategic bet on stablecoin leadership. The U.S. government sees stablecoins not just as innovation, but as a geopolitical strategy. Preserve dollar dominance in a world shifting away from USD reserves. Counter BRICS attempts at gold-backed currencies. Embed US Treasuries into dollar-backed stablecoins to generate global demand. Maintain programmable control over digital dollars for compliance, sanctions, and taxation. This aligns with efforts across Treasury, the White House, and major regulators to control the evolution of digital money, without ceding ground to unregulated crypto or foreign CBDCs. Footnote: Stablecoins offer the U.S. a geopolitical tool to extend dollar influence digitally and globally. 7. Technical backbone: the blockchain as a global payments operating system. Think of the blockchain as the Internet of Money. Open 24/7. Maintained by decentralized validators, i.e., miners, stakers, immutable, borderless, and resistant to censorship. Optimized by market competition to lower transaction costs. Stablecoins ride on top of this infrastructure. Tokens like Rust, USDC, or USDT function like apps built on a protocol. Validators earn income by processing transactions securely and efficiently, similar to oil producers selling into a market. This introduces an open, competitive layer to move value globally, one that can scale across countries, currencies, and use cases. Footnote: Blockchains serve as open, decentralized financial networks. Stablecoins are value units transacted across them. 8. Stablecoins are not investments, they're infrastructure. Unlike volatile crypto assets like BTC or ETH, stablecoins are not meant to appreciate. You don't invest in USDC, you use it. That's what makes it useful for real-world applications. Merchants want price stability. Consumers want frictionless payments. Developers want programmable tools with predictable value. It's digital cash, with superpowers. Footnote: Stablecoins are not speculative assets, they are utility-focused currencies optimized for transactional use.